Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Qiao, welcome to the show.
Thank you for having me.
I've seen you present a few times, and every time I come away, I'm just like, wow, you present very well. I don't know if there's a lot of prep that goes into them. There's wonderful slides. I know that much is true. And hopefully we can get a bit of that today. There are many things I want to talk about, including how you go about finding these small and mid-cap size companies that are focused on growth and in these sectors that have these really strong tailwinds behind them. But the fund has been running for a while now, and its performance, like obviously we're only in a little while, if we say that. We haven't reached the 3-year mark yet, which is kind of like the magical number for most people to study, but it's been exceptional so far. I would be curious, and I'm sure our listeners would be curious, you have obviously a wealth of experience. It comes time to launching a fund. What went into it first?
Yeah. Well, thank you for the kind words to start with, Owen. It's really nice to be here. Thank you for inviting me. Maybe let's take a step back. And before we even bought the first stock, let's talk a little bit of why we started this fund to start with. So the founder of Munro Partners, Nick Griffin, and I have known each other for years, and we are constantly talking about sort of new projects and what we should do. So one day, we started to look at, and really this is an area we've been focusing and looking at for a long time, is the small to mid-cap space. What really caught our attention is, we keep doing research on the tailwinds and the sectors and the stocks we really like on the big cap side. And we just keep running into these small companies that's growing really fast, that's incredibly cheap. And at some point, it feels like you're just walking past a $5 bill lying on the ground and wondering to yourself, what am I missing here? Why is it still there? So we said, well, let's find a dedicated vehicle to really sort of house our best ideas in the small cap space from Monro. So when we first started talking about launching this fund, it was early 2023. I still remember that was the cheapest the small to mid cap space globally was comparing to the big cap space in like 10 years. We said, well, this is the cheapest in a decade. That's a pretty great opportunity to start a fund. As we planned the fund, it took us a little while. It became the cheapest in 15 years. Because the gap just keep opening up. And we said, well, good, it get even better. When we finally gotten around to launch the fund at the end of October 2023, it was the cheapest in 20 years. So that's really the broader setup of how, a lot of these conversations started. But it was actually nerve-wracking as it sounded like a really appealing, no-brainer opportunity, but it was an absolute nerve-wracking experience as the fund manager to launch the fund. And I remember right before, I put together this whole portfolio of stock that we wanted to buy. And in October 2023, the entire market of small mid-cap fell another 400 basis points. So it fell 4 points. So everything I wanted to buy was down quite a bit as well. So you looked at it and you were like, wow. Either this is a great opportunity or I'm about to walk into a lot of things I didn't understand. As an outcome of that, we really triple check our math. I kept telling the investors, if a fund was launched right before a really big market drop, trust me, there was no hubris. There was no taking chances on the fund manager side. We triple check all our research, all our math, core management team multiple times. We were not taking chances with this. So as an outcome of that, we launched a fund with 25 really well-researched, really high conviction ideas, and the valuation levels were just incredibly appealing. So that was really the setup of the fund, and I think it really contributed to the success so far. But that $5 bills has been lying on the ground everywhere we look is still there. So the gap barely closed. So in 2024, fast forward, yes, the fund was up a lot, but that gap, that 20-year gap, stays completely intact, which is just absolutely mind-boggling to us. So this is really has been the fun of launching this small cap fund is there are just all these money lying on the ground. Nobody's looking at them. No one pay attention to them. And even after we pick them up, make quite a bit of money, still nobody's looking at them. So that's really, categorized our experience so far.
That's fascinating because, obviously at the time of recording this, over the last little while, obviously things like the Mag 7 companies have just kept shooting the lights out. And there's been a lot of, I guess, commentary around, well, if you exclude them, then what's happened, to the major indices around the world. And a lot of the rhetoric in 2024, it's like, oh, not that much, really. And it still seems like that's overlooked. And we often say on the show that the global small and mid cap is a huge opportunity for people to allocate into. And so it's good to see that experience in practice.
Yes.
So I would like to go back in time, if I can, to the very earliest days of your career once you graduated from school. This was in the period from 2006 to 2008, according to your LinkedIn profile. So that's where I'm getting this info from.
That's roughly correct.
Okay. So you took a job at Lehman Brothers. Now, I have a shirt that's a bit of a joke, Qiao. It says Head of Risk Management at Lehman Brothers. You've probably seen the one around before. But this is one of the greatest corporate failures in history from the GFC. People may remember this. And I often remark on the show that the first job out of school is the most profound on someone's career and how they think, even if it's not necessarily the best place for them to learn, but it just has a profound experience. And legacy, I guess, for them. I'm curious if there are things that you took from that moment in time. Like, what was that like going into that, what I assume was probably like still on the way up?
Yeah. It was clearly a very unforgettable experience. So I joined Lehman Brothers, as you said, straight out of college. I graduated from University of Virginia, packed my bags, moved to New York, and I started as a banker. And the real irony, which I didn't even put it on my LinkedIn profile, is I didn't just work at Lehman Brothers. I was an analyst in the financial institutions group at Lehman Brothers. So my clients were all the other financial sector firms, insurance companies, banks, specialty finance companies, obviously except for Lehman Brothers, since, our own employer wouldn't be a client. So for 2 years, I analyzed the balance sheet, the liquidity, the risks of, and I know them like the back of my hands, of a lot of the really major insurance companies, banks, brokers, and the one company I didn't analyze and never quite pay attention to was my own employers. And not only me, the entire financial institutions group, for the 2 years I was there, we never once had a discussion and say, hey guys, of all these discussions we're having on all the other people's problems, have we actually looked at our own employers? These are all reported public financials. It would have taken us 5 minutes to figure out what's happening. None of us ever did. So I think probably that was the first lesson to had, was just, sometimes we analyze the details and I call it, you get so close to a tree, you're practically having tree barks in your eyes, and you are completely missing the whole forest. The entire system was melting down. The entire MBS, the mortgage-backed securities, like all these issues we've analyzed to the 10th degree detail of the problems that happen in other firms, and we'll just never really take a look at Lehman. So when Lehman went down, it was an absolute shock. And this is actually speaks to the irony of it, is something that was probably quite obvious to outsiders, short sellers, a lot of hedge fund managers for months. But for the Lehman employees, and we are reasonably sophisticated, hardworking, smart people working at Lehman, it was a complete shock. When Lehman went down, 40% of the Lehman stock were held by Lehman employees. Nobody jumped ship. It just shows you how easy it is to miss the big picture of what's going on. So I think as an investor, that was probably one thing I always take away is am I going down a rabbit hole looking at a minutia detail while completely missing where the world is going? And that happens a lot in the investment world as well.
Wow, I didn't know the statistic about 40%. Because then you've got your career, you've got your retirement savings.
And you got vilified in media as, oh, you work at Lehman Brothers. Actually, the Lehman Brothers employees collectively were the biggest victims.
Yeah, wow. I'm going to switch from that, which is quite shocking, to something really positive. So I want to talk to you about your focus on technology companies. And when I say that, I don't just mean like hardcore software companies or platform companies. I just mean like the whole ecosystem, because I know the portfolio as it stands today is exposed to what you'd call industrials. You've got communications, you've got all different types of companies. But I saw a presentation that you did. It was actually at a Monro Partners retirement event here in Melbourne. And you used some examples, and I can't remember the exact companies, but I think it was NVIDIA and TSMC.
Yeah.
And you used this example of basically the world's internet. If you took all the usage, the kind of machine-to-machine communication on the internet has surpassed human communication and usage of the internet. And I wanted to ask you, given your background, both your work background, your academic background, if the focus on that was very deliberate, or if it was just like, I want the best returns for my money and for my skill set, that draws me to this particular part of the market. I know that's a kind of like a butchered question, but I'm just generally interested why you chose to focus on that part of the market.
Well, it's a really good question because I didn't choose it. So I came out of business school, and then just to connect to the previous question. So I left Lehman Brothers completely unaware of what was going to happen 3 months before Lehman Brothers declared bankruptcy. And I sold all my Lehman stock, paid for my MBA tuition, went to Beijing, watched the Olympics in August 2008, completely unaware of what's happening outside of the world. So I joined, I went to Boston for Harvard. The school started, and within a month, Lehman went down. So that's really sort of the first episode. For 2 years at business school, the best thing I've taken out, besides a huge group of great friends, is just think about what I really want to do. And I think the conclusion I draw after a lot of deep thinking and reflection is I really wanted to be an investor. I want to pick stocks. That was the overwhelming conclusion I draw. But I had no idea what kind of investor I was going to be. I've always liked stocks. I always dabble with stocks, but I didn't know what kind of stocks suit my personal style. I didn't even know there are personal styles. You just, by chance, the hedge fund that was willing to give me a job was a tech fund. And it turned out, again, just by good luck, that turned out to be still one of the best tech hedge funds in the world. It's Coatue Management. It's run by a legendary investor called Philippe Lafont, and he learned his craft directly from Julian Robertson. So, it was just an absolute fortune and with great luck that I end up at Coatue, and I was there for a long time. So I just learned, what the best technology investors figured out how they think about the world. And I was really hooked. I think that was really when I realized what I was good at as an investor. And I often tell people that want to come into the industry, there are a million ways of making money in the stock market. What you need to figure out is what actually works for your personality, what makes sense to you. And I could have ended up in a leveraged debt buyout shop, and I would have taken the job. So it was really not a that by design. Jobs were hard to come by, and Coatue gave me a job. That's really how I end up becoming a tech investor. But ever since I got in, I really never stopped looking at these large tech companies because it's fascinating, and also because what I've realized what I'm quite good at is to perceive change. And when change happens, it's a really exciting thing in the world, especially when you have very long-term change. And I also worked out that the human brain is very bad at doing compounded math. So when something massive that changes, like artificial intelligence, like the world going to mobile, if you actually look back at, the analysts estimated how many mobile phones there would be in the world, or now how much we think AI is going to take over the world, the conclusion back then was we might have overestimated the near term of what a technology could do, but way underestimate what in the long term that change would bring about. So I love that aspect of it, because in the journey of a technology adoption, there were just many opportunities to make money in the same stock, not just once, but multiple times over your career. So I consider myself incredibly lucky to really start my career at the start of the mobile era for technology, and somehow learn everything there is to be learned as a technology investor over the past 20 years. And now starting at AI era, having a rough playbook of what the adoption curve could look like and how exciting this could be.
Question on that. If you could have a time machine and go back to that point, right? Versus right now, do you think that opportunity was bigger than what is in front of you today? Like, if you had to, would you say that now is a huge opportunity versus then, or which one would you take?
I think AI is a bigger opportunity than smartphones.
Yeah, wow.
I think smartphones were incredibly important because it sort of give every human being a walking computer, right? That's really, when the computers start to follow human beings around. But ultimately, smartphone is helping human beings do certain tasks. So smartphones end up replacing PC, end up replacing phones, end up replacing lots of legacy hardware. But the core function of it is still human operated, human enabled. And back to your earlier question, in 2018, that was when all the data created by machines in the world surpassed all the data created by humans like you and me. And now 99% of the data created in the world is created by machines. So humans combined with all the smartphones, all the PCs, actually produce 1% of the entire data load in the world. We can't possibly understand what this data means. We can't possibly understand what these data can do. Only artificial intelligence can really do that. So I actually think this is a much bigger deal. It fundamentally changes how these algorithms work.
I want to spend a bit of time talking about the process, because this may be a useful lens for what we were just talking about. But I'm going to do something I've never done before in the 6 or 7 years of running this show, Qiao, which is I'm going to start in reverse, because there was a video of you, it's on the Munro website, I'll link to it, in which you talk about a moment when you caught up with Nick, Chief Investment Officer of Monro, and he mentioned to you the use of stop losses. And it seemed like you were skeptical. As, to be honest, I am, if I'm being honest.
Yeah.
Can you talk us through what that kind of dialogue was and what you saw?
Yeah, so Nick and I were having a coffee, and then he was walking me through the stop loss process, and it's a really simple process. It's a process that says if a stock falls 20%, either from its recent peak or from the cost where we buy the stock, it's not a forced sell, but it's a triggered alert. What the team end up doing is we all get involved, we all review the stock in a lot of detail, and the stock gets repitched to the team within a week as if this were a new stock. And only when you have unanimous agreement across 12 members of the team do we keep the stock in the portfolio. You have one dissenting voice, we sell the stock. We can always come back to it, but we sell the stock. And it's a really simple process. So I was like, okay, great, that makes sense. And then he showed me in 8 years of running money, this process has never lost more than 100 basis points. That's 1 point of losses. And I just sat up on the chair and I said, no way. Because I've worked my own share of hedge funds and long-only funds and value funds. I've seen just funds losing money by really any style. And to lose 100 basis point on one stock means, and especially as you run a concentrated portfolio. So if you never run position size larger than 150 basis point, fine, you will never lose more than 100 basis point on the stock. But Munro takes concentrated positions. It's not uncommon at all for Munro portfolio to have 5, 6, 7, 8% positions. And for that position to be down, not even 20%, which for growth stock that could happen just missing one earnings. you were down 100 basis point. How is that even possible? You've never lost 100 basis point on the stock. And I went back all the numbers. I audited. I did my own audit. It was true. And for the Munro investor presentation, we have this chart that is a really simple chart. It shows when we are right about a stock at Munro, we make multiple times our money. Well, we're growth fund managers. You expect that. But when we lose, the biggest losers cumulatively over the past 8 years, none of them was more than 100 basis point. And to keep that chart alive and well is more important to all of us collectively than to be proven right on any single stock. And that's really where the magic is to really control your risk. You need your investment teams to put their personal ego aside. When you lost 20% on the stock, you feel pretty crappy about yourself. You want to prove the market wrong. You want to prove in front of your coworkers that you still got it. But you have to have that neutral mindset, that open mindset that say, you know what, to keep that picture alive and well, it's much more important for me to be proven right on stock X, Y, and Z. So you listen to your coworkers, you get stopped out, and you can always come back later. And now I've seen it in practice for quite a number of years, and I can tell you that that really indeed works.
Fascinating. So other than Nick's love for fly fishing in Tasmania, if I'm not mistaken, there were some really good nuggets that came out of our first conversation that we had quite a few years ago. But he had this ability to kind of captivate any audience and still does. And in that, we talked a little bit about the investment philosophy that's followed at Munro, which, as you've alluded to, is kind of the same across all the strategies. Yep. Can you refresh anyone's memory that may be tuning in for the first time? Let's start at the philosophy and then we'll dive down into the process. What is the overarching philosophy that you follow?
Yeah, so the overarching philosophy is really simple. The overarching philosophy is the stock market is made up with very, very few winners and lots of losers. So as a way of investing, you have to figure out how to find the winners, how to hold on to the winners and let them run. And then at the same time, face the fact that more likely than not, you're going to have quite a number of losers at your hand and deal with it. There was this study, Nick probably quoted the study as well. Is an American professor that did a study on American stock return over the past 1 century. So over 100 years, over the past 100 years, 26,000 companies have been listed at any particular point in time, created roughly, call it $35 trillion US of wealth for the shareholders. But out of the 26,000 stocks, the top 1,000, which is less than 4%, accounted for all the wealth created. Every dollar of that 35 trillion were created by the top 1,000. And then out of the top 1,000, the top 50 companies in 100 years end up creating about 40% of all the wealth created out of the stock market. And, we quoted this study externally, but we actually think about the study more deeply internally. My job is a stock picker. How humbling is it to tell you, hey, you know what? You think you are great, but statistically speaking, 4% of the stocks are going to be winners. You think you can find a 4%? And that's really what we're trying to do. We're trying to find a 4%. But I would love to see her and tell you, hey, Owen, I have 35 stocks in the small cap positions. They're all going to be awesome. Statistically speaking, that's just not going to be true. If I do my job really, really well, I can find 4 or 5 out of the 35. I just don't know which one. And then, but all the other ones are going to be losers at some point. They have to get stop loss out. So we designed the entire process from finding the winners, backing the winners, holding on to the winners, all the way to that stop loss process to deal with the losers. And I think these statistics really drive, and that's really the power of philosophy, right? It's an overarching philosophy. Whenever someone is getting stubborn on the stock, you can just remind them, do you really think, the depth of your heart, that this is one of the 4%? And then instead of say, well, maybe I don't think there's a level to sell it, but I don't think it's a 4%. And that's your honest answer. If it's not one of the top 4%, if it's not one of the winners, you gotta let it go.
I'm going to jump to something that I wanted to ask you about, which is this idea of a killer product, right? Because I feel like this might help us understand the process as well. Is you've got this huge opportunity set, global small and mid caps. I don't know how many companies are in your universe, but it would be...
It's about 6,000.
Right. So there's a lot. And then you want to build this concentrated portfolio of winners. Does it start with the product or does it start somewhere else?
It starts with the areas of interest. It starts with a tailwind.
Okay.
So when we go back and study that top 50 stocks in the Henry Besson-Biner study, we find there was one thing that was in common with all of them is, you start to ask the question, well, if all the other 25,000 companies fail, what makes this 1,000 companies special? Or what makes the top 50 special? Well, the two things that really stand out. One is these are all growth companies for a very long period of their lives. That's how they compound success upon success, and that's how they become the top 50 companies. So you don't have a company flatline over 100 years, just not go down. You don't become one of the winners, right? So that's the first conclusion. The growth companies really end up becoming massive stock market winners over time. The second one is, well, what make them grow? What make these companies grow year in and year out? What make Visa grow 30 years in a row, right? They don't get to grow like that unless they have a massive structural tailwind behind the back. So that's really the research on Munro. We start with the structural tailwinds because we know there are many companies that can grow 1 or 2 or 3 years, but to grow 5, 10, 15 years in a row, which is really, these are the things we're trying to find, you got to have a multi-decade structural tailwind. So there are about 20 of them that we do a lot of work on at Munro, but not all of them will have an actionable stock idea at any particular point in time. So at any particular point in time, 7 or 8 structural tailwind will be 85% of our portfolio. And then all to the rest, because this is really goes back to focus, to the rest of the companies, we say, that's great, you're growing like that, we might miss you, but if you're not in one of these structural tailwinds, we just don't have the confidence you're going to really grow more than 5 years in a row. So that's the first thing we start. We start with the structural tailwind. So high performance computing, which describe this whole slew of hardwares that goes into powering artificial intelligence, powering machine learning. That's the entire structural tailwind, and we call it, high performance computing AOI. We have climate, which just goes after all these companies that is enabling power efficiency, enabling decarbonization. That's our climate AOI. So we have, quite a number of them. So back to the killer product. That's the second thing we look at is, okay, you're in a massive tailwind, right? We know the tailwind is going to carry you for a while. But even in the same tailwind, some companies win, some companies lose. So the first thing we're looking for on the company specific level is a killer product and a killer service. And it's a really, really simple test to it. The simple test is when your customer hear your name being mentioned, is there a little smile that forms on their face? That's it. And I'll give you a specific example of this. So one of the first stocks we bought for the Munro Small Midcap Fund was a company called Shark Ninja. And when we first bought it, it was a recent American IPO, although the company was listed in a different format in Hong Kong for a long time. But this is a pure American, European business based out in Boston, led by a founder, growing really fast. And they make two things. They make the kitchen appliances under the brand Ninja, and they make cleaning appliances like vacuums and different larger appliances under the name Shark. And when I first put up the stock on the big screen in the boardroom of Munro, which we look at for every single new idea, there was just visible, audible laughters around the world, around the room. People were like, is it Shark or is it Ninja? Why is it so funky? And all the blokes start making jokes about it. It was quite funny. And then they look at the category and say, small appliances, come on. Like, no way, we're not going to invest with a small appliances company. Until our research coordinator, who was sitting in the stock meeting with us, which she is the only other mom outside of myself in the room, she said, but I have Ninja product. I love them. And it was a very soft, gentle comment. And the laughter just stopped. And everybody just sit up straight, be like, really? Tell us about your Ninja. And then she said, well, I have a blender, I have a multi-cooker. It's pretty cool, really helps me with my kids when I need to whip up something quick. So then you can just see the machine turning. And after that, no one laughed anymore. And then the great thing is they all went home and looked at their own kitchen. And the next day, people came to me and said, wow, I had a Ninja appliance in my kitchen. I just didn't know it was Ninja. And then I asked my wife about it and she loved it. And then I have a Shark vacuum in my house and then it worked really well. So that is the definition of a killer product, is when your customer hear your name, they vouch for it. They say, no, this is a great product. So we end up buying Shark Ninja for the small mid-cap fund. We even bought it for the main fund. And, we more than double our money on Shark Ninja because it really was just that massive growth story through innovation in a category that's not growing. This company can actually grow 20 to 25% a year, which is just really, really impressive. So that's an example of a killer product that we're looking for.
Yeah, wow. That's a great story too. I'm going to go home and check. I don't know. I feel like maybe I've got my vacuum from Aldi or something like that, but I'll have a look. Another thing that you speak about is this idea of control, which if we were in private markets, that would be probably the first thing that people ask is like, who owns it? For some reason, a lot of people I don't think spend enough time on this in public markets. Can you talk us through this aspect of what you look for?
Yeah. So control really means alignment of the company or of the people that's running the business, the people that's owning the business. Are they aligned to you as most likely a public shareholder or a minority shareholder? So we are, unabashed backers of founder-led companies at Munro. The small mid-cap fund has more than half of the portfolio holdings of founder-led companies. And we love founder-led companies because that's in a lot of ways where the alignment is just the strongest. There is no one that works harder than a founder of the business. I mean, Owen, you would know. I mean, this is your business. You don't clock your hours when you're doing podcasts. You would do as much as it takes to make this business successful. That is the mindset of a founder. With growth companies, the founder ownership and the founder stewardship is particularly important because if you think about what really make a growth company successful, it's never just one strategy and it's never just one product. So every couple of years, you have to do a major pivot, either expanding to a new category, expanding to a new product, or change your strategy completely, or the technology change. Think about when Facebook first started, it was just a website, and then it became a mobile app. Then it bought WhatsApp. Then it bought Instagram. Then now it got into AI. Without a founder with a majority stake and control at a stake, these are just not the pivoting decisions that could be done by a board. A board or a collective management team or executive management team is very, very good as a steady pair of hands. But if things need to change very, very quickly, sometimes in a very risky way, sometimes in a very agile way, a lot of times in a very unpopular way, you just have no one that could be a change agent better than a founder. So that's really why we love the founders, because over and over again, we found them navigate the difficulties of the industry, the challenges that come much better than a team of collective decision-making executive management teams. That's the first thing we're looking for, control. I think the second thing is, and I'll also give you an example. So for about, call it 40 years, Nike ruled the athletic wear market. First, because Nike was led by a legendary founder. But after Phil Knight left Nike or were retired, Nike had a whole series of professional management. And we could actually notice the decisions getting made much more shorter term. They are trying to capitalize on this very hot trend. They're running their legacy franchise probably a little bit harder than needed. They're trying to make their quarter-to-quarter numbers. So and you start to see the decline of the franchise. You start to see the investing or the investment back into the business start to lack. But then you look around the world, you say, well, still no one could challenge Nike. Literally nobody can, right? Nike got to $50 billion of sales. No one come close. Then there is a small company out in Switzerland called On Running. And we get to speak to management team. We get to watch what they're doing. And we were just so impressed with, and these, because it's run by 4 founders. So these 4 friends, all completely crazy marathon nuts, based out in Switzerland. They designed a shoe that did not have major, sports star sponsorship. They just designed a shoe that is just great to run in, great to walk in. And then they end up making all these decisions, not to copy Nike, not to copy Adidas, but to be themselves, be completely authentic, but also run the business for the much longer term. On has just crossed the revenue base of roughly $2 billion US, and we think it's the only brand in the world that have a chance of actually standing up to Nike 10 years from now, right? I mean, that is a huge endorsement, and the only reason we're saying is because we see how they invest in the business with technology, with product, going ahead of time, taking risk. Like you just see all these decisions really made for the long term and not to try to meet the quarter to quarter. So really across all these industries, what we're backing is a long-term thinking investment team. And I think that control element is basically the human behavior guarantee that you're going to get this kind of long-term decision making.
Yeah, wow. When it comes to just in terms of what goes into the portfolio, if we think about just portfolio management for a second, is there like particular rules that you have for putting something in the portfolio like that example? Like, are they set really stringent, kind of like the stop loss idea? Or is it, there's a particular mix of areas of interest or AOIs as you shorten it to? Can you talk us through just how you think about portfolio construction and management?
Yeah. So, the individual stock picking is bottoms up. So every stock, like On Running, like Shark Ninja, they made it into the portfolio, not because I was looking for sportswear exposure. I don't look for any exposure. We're just trying to find ideas that make money. So they got in because the earnings growth on our model is far greater and far more sustainable than what consensus is thinking. And then in the case of Shark Ninja, it was just incredibly cheap. We end up paying about 13 times price to earnings for something that was growing 25% plus. And over time, we think Shark Ninja will also get a multiple re-rate. So the earnings upside and the multiple re-rate are really the 2 main things we're looking for a particular portfolio position. And lastly is the catalyst. So ahead of a catalyst that we think is really going to realize the earnings power, we tend to supersize the position. So that's really what I call 85% of our work, going to stock-based, stock by stock, making sure our numbers are right. And that's what we spend our time on. As a portfolio manager, what I want is to deliver to our investors a portfolio of stock that is driven by diverse growth drivers. So I really want to have 7 to 8 significant areas of interest. That really means by the time I look at the 6th or the 7th idea coming out of high performance computing, the bar just became really, really high. And I say, guys, I've already have 5 different positions together. They're 17% of the portfolio. Let's dial back. And I don't want any particular areas of interest in general to be more than 20% of the portfolio. And we design it this way because I think, this is a growth portfolio. We want to deliver to the investors, really sort of 7 to 8, hopefully uncorrelated growth drivers. And we think over time that get people a much better experience than to be, leaning way too much into semiconductors at this point or leaning to defense tomorrow and then just have this swaying effect. So we want to be longer term. We want to churn the portfolio less, and we want to have these diverse drivers.
There's a follow-up here, which is, so say you talk about growth. How do you think about that? Like if you could, there's obviously a huge mosaic that goes into this. There's a lot of IP at Munro and in your team. But if we could boil it down to some elements, like I'm interested to know, a lot of the companies I'd imagine are emerging in their competitive advantage, or they have something and they're just reinvesting and reinvesting and reinvesting. But then would you kind of, like if I'm thinking about indexing to factors in your process, would it be kind of like more attention is paid to earnings per share to then get the catalyst to hit that earnings per share and push the multiple up? Or is it more like, what is the sustainable return on invested capital? How much is industry growth versus, the business growth? I don't know if I'm making any sense here, Qiao,
You
but
are.
feel free to just how it's all of this, the above. But I'm curious, like how you kind of pin the growth potential of a company to not just now, but in 5 or 10 years, which is like your horizon.
Yeah. So, I mean, it is all of the above, and this is not me being tongue-in-cheek, right? So if you're thinking what we're trying to do here, so we start with the long-term tailwind, then we go into the behavior of management team, and then we go into the quality and if you're a killer product or service. All these factors are basically our way of figuring out if the growth is sustainable beyond what we can see, and then ultimately it's all about earnings growth. And this is one thing that set Munro apart from a lot of the very early stage. We don't actually invest with storage stocks. The storage stocks that don't generate revenue and don't generate profit, we frankly don't really know how to value it. So the small mid-cap space, yes, is small cap portfolio, but I don't have a single company that's unprofitable today. Not only they're all profitable, they all generate positive free cash flow. They don't have leverage. Like these are some of the really high quality growth companies that we can find. And back to your earlier comment, I have 6,000 companies I can pick from. In general, they are quite a bit cheaper than a large cap fund. So really the opportunity at this point is just fantastic to do what I call tick all the box investing. I tick all the boxes for one of these small cap companies, and we don't have to go into the unprofitable, unproven business model. We just really don't need to at this point of the market to take that kind of risk. So that's one thing, but ultimately it's about earnings growth. Earnings growth drives stock price. That is our credo. You look at all these great growth companies, ultimately the earnings growth reflects, or the stock price growth reflects the earnings growth. So what we try to get at is to find companies that grow revenue at least twice the pace of GDP. So revenue will be at least high single digit growth. We're looking for earnings per share, roughly double digit. And the simple philosophy mathematically is to say, if we are right about delivering you, our investors, a portfolio of companies that can grow earnings per share double digit, over time, the returns of the portfolio should be double digit. And that's really what we're looking for the investors.
Yeah, that's fascinating. And that's kind of where I was trying to get at, is like people might look at your performance over the past year and just be like, wow. And then over 5 years, 10 years, you kind of get a smoothing out of returns. You'll get some years where it's harder than others and some years where it's great and what have you. But the kind of like underlying trend is, what are you getting when you invest with you is that potential and that ongoing potential, right? And so through time, that's what I was trying to get at. And makes sense.
Yeah.
Yeah. Okay. So I've got one follow-up question, which I wanted to cover off on, is you mentioned before about like control being really important, and you used an example like Facebook's various iterations and adjustments over time. That's really interesting that you say that, because a lot of people in their mental models, they're not used to the idea that they buy something today and it changes.
Yeah.
Like they just, the variability just spooks a lot of people. But in that case with Mark Zuckerberg, he was in front of the Senate, hashtag delete Facebook. We were going to rename it from Facebook to Meta. All of these, I'm going to spend $10 billion a year on this thing called the metaverse. And for all intents and purposes, he just seemed like a crazy person. At least that's what the media portrayed, right?
Yeah.
And I guess this is more not necessarily like an exact science perhaps, but like, how do you maintain conviction necessarily when there is a founder that has more than, say, 50% of influence or really can't be removed? Like we see that a lot, right?
Yeah, you have to align yourself with his vision. Right? And there are founders that never make money also. So we're not saying all founder-led companies are great. But that Facebook example is a great one, because imagine if Mark Zuckerberg were not the founder. If he were just a professionally appointed board-appointed CEO, he would have been gone a long time ago.
Yeah.
And he invested with AI quite a bit, ahead of the curve. And again, a professional CEO would not have had the gravitas and the power to say, I'm going to spend $10 billion a year on this and $20 billion a year on that. So I just think a lot of these investments, especially when you're investing ahead of time, when no one else sees your vision, it's really hard. And that's why you need a founder to make all these decisions. And you make a great point, Owen. Like a lot of the growth companies, they were just not the same company when you look back. Apple is not the same company as it was before. Apple is 35% software today. 8 years ago, it was a pure smartphone hardware company. And 15 years ago, it was a PC company, not a very good one. So all these growth companies really changed tremendously along the journey. So you do have to understand as a growth manager, not just the product they're doing today, the product is selling today, but what is value, is position within the ecosystem, and figuring out, are they going to benefit more when the world's going their way? And back to the smaller companies, one of the things we really end up using a lot of these learnings that we've derived from investing and making money out of NVIDIA over the years, or investing and making money out of Facebook along the years, to really shed some light on where the world is going. And we use that insight to find the small mid-cap companies that is really they're just hiding in plain sight, benefiting from a lot of these similar trends. Yet, you can buy them at a much cheaper valuation than some of these large cap, well-followed companies. And that's really been the joy of us, to use these insights we already have at Munro to find these small companies as beneficiaries, yet completely overlooked.
We were talking off air before about people that wanted to invest with you. They can head to the Monro website. I'll put a link in the show notes. It's munropartners.com.au. There's no affiliation between Rask and Munro and anything like that. So I just think it's fascinating what you do. And I think there'll be some torque, let's put it that way, between like the variability in your returns through time. But I think the way you and the Munro team conduct yourself is like first rate. And I think it's like...
Thank you.
You're very welcome. And as an expression, I think of portfolio construction in terms of expressions, Qiao. Like as in, if I want global growth, where do I go for global growth? Like, is it passive, active, systematic, factor funds? Doesn't really matter. But how do I get like the pointiest exposure to what I'm trying to get? That's my expression, right? And I think what you do is very much at the pointiest end of, I want growth companies and I want them to do something that's different. Like, I think that's right at that point. And I know our community loves small cap companies. So there's heaps of literature. If you're watching this or listening to this, head to the Monro Partners website and find out more. And there'll be a link in there. One of the final questions, it is the final question that I ask to anyone that comes on the show. It's very philosophical. And you can take this however you like. But it's if you could go back in time at any point in your life, go back and give yourself one piece of advice, whether it was investing, finance, business, study, whatever, what would it be?
I'd probably give my younger self two pieces of advice. One is just be comfortable at who you are and don't try to be someone else. Mm-hmm. And this sounds cliche, but I remember myself for decades asking myself, am I American enough? Am I not American enough? Am I liberal enough? Am I conservative enough? Do I work too hard? Do I work hard enough? Am I too outgoing, or am I too conservative? I think self-doubt is a big part of growth and youth. But self-doubt at some point also takes up a massive amount of mental space and really stop the growth. So I could genuinely see the growth reaccelerate as an investor, as a person, as a wife, as a mother, after I'm just completely comfortable at being who I am and telling everybody the truth all the time, and not to try to be someone else. I think that's been really liberating, just to clear that mental computing memory. If you're using nerd talk for AI. I think the second piece of advice is you're gonna laugh at this, Owen, is to find a financial advisor / planner early. And I can't tell you, both me and my husband, we were finance professionals and really making money from quite an early age. But you will be surprised in how many finance professionals, a little bit like the Lehman bankers not looking at our own balance sheet, like how many people work in finance and still don't really have their financial affairs in order. And it's a huge cost over the long term to not properly invest as soon as possible of your personal wealth and have your money work for you. So I learned that lesson probably a little bit too late. But that would definitely be one of the things I tell my younger self.
Wow, both of those things are very profound and very unique. I've been doing this for 6 or 7 years now. I don't think anyone's commented particularly about self-doubt. It's a very thing that's close to my heart as well. So very well said, Qiao. Thank you for venturing all the way down, potentially on the tram, on this lovely Melbourne morning. It was really lovely to meet properly and to have this conversation. So thank you for joining me.
Thank you so much. I really enjoyed the conversation. Thank you for having me.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.